In this week's video, we'll cover an extreme and rare signal that was recently flashed on the weekly chart of the S&P 500 and answer the question, what does it mean for stocks? And Friday's gains came with some additional clues. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Regular viewers and clients will remember this list from October 2nd. We're not going to cover it again, but December 4th, Friday, after the payroll report, there were a lot of similarities in the day's session to the intraday reversal on October 2nd. All things being equal, that leans bullish. For example, these aren't the closing numbers, but the early returns say that volume on Friday's session, December 4th, was 167 million shares, which is about 40% higher than the average day of 119 million going back 3 months. And maybe more importantly, there was more conviction and volume on Friday's big up day, which was a greater percentage gain than Thursday's big drop, 167 versus 143 at 4 p.m. We'll kick off this week's video with another extremely rare reading on weekly MACD that occurred on Friday, October 2nd. This is a similar signal to the rate of change and Kopik curve analysis. One was in a video, one is on short takes. Why would we do a third analysis? Let's assume you're in your car and your temperature gauge says you're overheating. It's possible that your temperature gauge is broken and you're really not overheating. But if you have 3 temperature gauges in your car or redundancy built into your system, and all 3 of them say you're overheating, most likely you're overheating. The rare event was this. S&P 500 weekly, we're looking at weekly charts for this MACD analysis. The black MACD line dropped down to negative 34.41. How rare is that? The answer is extremely rare, especially within the context of a bull market. But in this video, we're also going to look at bear markets to try to see how indicators and math and hard data can help us differentiate between corrections and bear markets. This blue line here, horizontal line, is the negative 34.41. You can see we just hit it in 2015 on a weekly closing basis. We went below it in 2011. We went below it in the 2008-2009 bear market, in the dot-com bust bear market. To give you an idea of just how rare this level is, we did not hit that line in 1987. We're going to walk through each of the cases, try to figure out what's different between a bear market and a correction, and then compare those cases to the present day. What is MACD and how can it help us? The net bottom line is it helps us with trend following and momentum, which are 2 key components of the CCM market model. So this video will demonstrate a lot of the concepts used in the market model and give you some good visuals of how it handles bull markets, bear markets, and corrections. MACD signals are very, very similar to moving average crossover signals. When black goes above red, that's a signal, and when black goes below red, that's a signal. The second primary signal is when black crosses the center line. So we have a signal line crossover, black above red, or a center line crossover where black either goes above or below the 0 line. Those are the 2 signals that we'll be looking at, and the primary signal will be moving above and below the center line in this exercise. If you want to learn more about MACD, you can Google MACD and stockcharts.com. Our analysis since the October 2nd low has been slanted to the bullish end of the spectrum. Why is that? Well, that's the way the data has been slanted. However, is it possible for 2015 or 2016 to morph into a bear market? Absolutely, positively, Yes, so let's look at MACD during the last two bear markets and see if we can learn anything to differentiate between a correction within the context of an ongoing bull market and the onset of a new bear market and ongoing bear market. This level right here, the blue line, is negative 34 basically. This is the rare level that was hit in 2015 in October. So this is one of those rare instances. In this case, it did occur in a bear market. So you can make an argument that what just happened in 2015 is not a correction, it's a bear market. And that's a fair question or argument. Was weekly MACD helpful in this instance during the 2000 to 2002 bear market? The answer is yes. Our signals are the signal line crossover. We get a bearish cross here. It should be pointed out that the reason why the market model diversifies is MACD perfect from a signal line crossover perspective? No. This is a difficult period in here. That's why we diversify. That's a bearish look here. And we get the more important signal, and this is the one the market model weights higher. The center line crossover is more important. You can see we never get a center line crossover here. Black goes below zero here when the S&P 500 is trading at 1374. Notice we never get or recapture the zero line, so we never get a bullish center line crossover during the remainder of the bear market. So MACD even here from a center line crossover perspective is saying be skeptical of this counter trend rally here. So from the time that we got the center line crossover from a bullish perspective, the S&P 500 dropped 43% from this point here to the intraday low of 776. So in this case, it was helpful. This was helpful in terms of cutting risk before this decline. And it was also helpful in terms of saying these are most likely counter trend rallies within the context of an ongoing downtrend. Point C here is basically the end of this bear market. Before we shift gears to the financial crisis, the key takeaway is the S&P 500 dropped below negative 34 in terms of the black MACD line in 2015. That's this level here. Notice after that happened, we never recapture the zero line. That's the key takeaway during a bear market relative to a correction. This is the year 2000. This is 2002. Same exact concepts. Now we're looking at the financial crisis bear market. This is 2007 here. This is 2009. This is the weekly S&P 500. This is our MACD. Point A is where we are in 2015, at least where we were in October when we hit the low below negative 34, which is that rare reading. In the bear market, did we ever recapture the center line? No, we did not. This is the highest point here. Counter trend rally in the spring of 2008. We do not recapture the zero line. From that perspective, telling you to be patient. And for the remainder of the bear market, we do not recapture the zero line. The signals here. This is our center line crossover. This is a bearish signal here. This black, this is bearish here, this is bullish here. Counter trend rally, bearish again, we drop. Was the bearish center line crossover helpful in late 2007? The answer is yes. We get the cross here. S&P 500 is trading at 1440. This is your bearish look. It's never taken back by crossing above the center line. After the signal, the center line signal, the S&P moved from 1440 down to the intraday low of 666. This represents a 53% drop after the MACD centerline bearish crossover. Just to recap what we're looking at and why we're looking at these particular periods. 2015, MACD comes down here. The only other times that it's happened since 1982, it occurred in 2011 here, and it occurred in the two bear markets that we just covered. So there's a reason why we're looking at this period, and this period. 2011, we know that weekly MACD in 2015 dropped below negative 34, which is point A here. This is below negative 34 in 2011. We just covered that once that happened in the 2000 to 2002 bear market, we never reclaimed the zero line during the bear market, and we never reclaimed the zero line for the remainder of the 2007 to 2009 bear market, which begs the question, was there any discernible difference between the bear markets and the correction that meets our study criteria? The answer is yes. Unlike the two bear markets, we did, in fact, recapture the zero line, with the black level being 2.956 on January 6, 2012, when the S&P 500 was trading at 1277 and change. So this is a sell signal here. This is a buy signal here. This did help us cut risk during a volatile period, and we know in the bear markets, after this happened, really bad things happened. So from a probability and prudency perspective, protecting capital in here is not a bad idea, since the odds are really not in our favor. After we reclaimed it and basically said this looks more like a correction, what happened? As we've noted many times in these videos, no indicator is magical, and that includes MACD. That's why we diversify. But you can see here, negative signal here was helpful before this. This is telling us maybe we're looking more like a bear market. And then after we get the bullish recapture of the zero line, which did not happen in the bear markets, from that point here to this point here, the S&P 500 gained an additional 11.35%, and thus weekly MACD can be helpful on the way in and the way out, especially when we consider risk versus reward for our capital. Less favorable, more favorable, more favorable. Good things happen. Thus, from a probability perspective, in 2015, all things being equal, if we're unable to recapture the zero line, which is what happened in the two previous bear markets, the odds of a bear market would remain elevated. If we're able to recapture the zero line with a weekly close above the zero line, the probabilities of the downturn being a correction rather than the onset of a bear market start to improve. So the million-dollar question is, have we had that yet? The answer is yes. On Friday, November 27th, we recaptured the zero line and closed at 3.287 after falling down into the rare territory. And remember, our bullish signals are black above red, that's like a moving average crossover, and then a center line crossover on a closing basis on a weekly chart. Both signals have occurred as of the close on Friday, November 27th, which simply speaks to probabilities. It doesn't eliminate the bear market scenario. It just says it's a lower probability outcome relative to the case where we do not recapture the zero line. Can't emphasize enough, MACD is one of many inputs that the market model uses. Also keep in mind that we recently had a very similar analysis in two cases. We used rate of change for one of those and the Kopic curve. All three of them are leaning towards bullish probabilities looking out several weeks. These are longer term signals. We could be talking 10 weeks, 3 months to multiple years on some of these signals. We're not talking about days, hours, or even in some cases, weeks. A fair question might be, Chris, there are so few cases here, this is not statistically significant. You can Google this title and find this article on our blog, Short Takes, and then if you scroll down pretty far. There's going to be a subheading down there. It covers sample sizes and that question in detail. So you're looking for, but 6 or 7 occurrences are statistically insignificant. And then it provides some detailed information about a special branch of statistics and small sample sizes in the financial markets. Since all things being equal, we would prefer to have a larger sample size. While these cases here do not meet our criteria, meaning in 1998 we did have a sharp drop, but we didn't hit the blue line. 1990, this is pretty significant relative to the big picture. And in 1987, of course, MACD came down pretty far. So let's look at these cases and see, and all of these were within the context of a secular bull market. Were they helpful at all from a probability perspective? 1987, from a probability perspective, we get the bearish moving average crossover before the waterfall plunge or Black Monday. Then we get the bearish centerline crossover here telling us that the probability of a bear market is now elevated. Why would I want to take action here, potentially? Because when we get a signal like this, it's telling us that the odds are deteriorating. We don't know in 1987 that it's more of a corrective process. We could enter into a bear market where after the signal from here to here, the S&P 500 index lost almost 54%. As we discussed a few weeks ago, if I lose 54%, I have to make 117% plus to get back to break even. And maybe more importantly is, if I'm retired and taking distributions using the 4% rule, it can take an incredibly long time for my portfolio to get back to break even, as we showed a few weeks ago. In this hypothetical case, to get back to break even after a huge loss, it took over 6 years. Therefore, when the lower probability signals start to pile up, it can be prudent to reduce risk. Was MACD helpful in terms of telling us when the probabilities were improving? Bullish moving average crossover, and it did recapture the zero line, unlike the 2002 bear market and 2007 to 2009 bear market. Before we go over 1990, it should be noted that we don't use any signal in isolation. In technical analysis and mathematics, you're much better off using multiple sources and then making decisions based on the weight of the evidence. 1990, this is a sharp correction. Bearish, bearish. Did it help you get back in? Bullish moving average crossover. And unlike the 2 bear market periods, we did recapture the zero line in early 1991. After that, good things happened. Remember, these examples are only similar to 2015. In 2015, we went to negative 34. In 1998, we only went down somewhere around the high teens, but it's the same concept. Be careful, be careful. Bearish cross, which led to bear markets in the past, doesn't mean it's going to be a bear market. It just speaks to deteriorating probabilities. Did it help you get back in? Yes, you get a bullish cross here, and you recapture the zero line around the same time. And after that, on the weekly chart, good things happened in the S&P 500 index. Moral of the story: in these relatively rare and extreme cases, MACD was helpful from a probability perspective. Probabilities imply that some of these setups are helpful and some are not, which is why we diversify and make decisions based on the weight of the evidence rather than just looking at weekly MACD for the S&P 500 index. If you were following along on Twitter on Thursday during the big down day, you may have seen that we said the math and the data is allowing us to be patient here, and let's go over some of that. These are weekly moving averages used by the CCM market model. There's nothing particularly magical about this set. The model is highly diversified for that reason. This is the look here when the stock market rolls over in late 2007. These are the exact same weekly moving averages as of 3:24 p.m. on Friday, December 4th. Slopes down, blue on the bottom here. This is a riskier look. Here we now have blue, the fastest moving average on top, and the slopes are all up. All things being equal, this is a better look from a probability perspective than here, here, or here. When signals occur on multiple time frames, they become more meaningful. Hence, the last charts were weekly charts. These are daily charts, the exact same concepts here. November 21st, 2007, you can see blue is on the bottom and blue stays on the bottom. Now we've extended this bear market chart out so we can compare it here. You'll see on the rally attempt in 2008, we have the tight cluster. We never get white space in between, and blue never convincingly takes the top spot. Slopes are down for the most part. This looks better today. We have blue on top. The slopes are up. Somewhat of a tight look. If anything, this period here looks more like this period here than this period here. All of it simply speaks to probabilities. Same concepts, now we're just using faster or shorter duration weekly moving averages. This is our low probability look here in September of 2008 before bad things happened. This is our improving probability look in the spring of 2009 on the weekly S&P 500. How does the exact same chart look today? Regular viewers know we would classify this as a full bore bullish look. This looks more like this period here or this period here than this period here, here, or here. However, the one thing that we would like to see that didn't happen, we'd like to see this chart make a higher high here and then a higher high here. So this chart looks good, but the S&P 500 still has some work to do. Is there anything to worry about as of Friday, December 4th? Of course, there's always things to be concerned about. Really no resolution here yet. We're still below 2130 and these levels here. On the glass half full side of the ledger, we're also above 1990. The market is either going to make a higher high above this level or a lower low below this level. And preferably, we'd like to see it make a higher high above this level and this level. I know it's been an extremely frustrating period for many market participants and clients. Take a little perspective on it here. The S&P 500 sometimes skews it. This is the broad NYSE Composite Stock Index. Thursday's close here or low on December 3rd, 2015. We can draw a horizontal line and go back 745 calendar days. No progress point to point with a lot of volatility between point A and point B. We had an 11% odd waterfall plunge, and then we recently had a 15.5% waterfall plunge. From here in September, in the low, back to October 2013, same thing, 718 days with no progress. However, when the Fed is adjusting interest rates, we can get indecisive markets. 2015, last 2 years, we go sideways. 1993, 1994, early 1995. The key to success during the frustrating periods is if we continue to execute. Usually after you go sideways, you get a big move up or a big move down. 2010, harder markets are usually followed by easier markets. This is a 27% move. Do we have any reason in 2015 to believe that it's possible that the harder market will be followed by an easier market? We do. In this week's video, we just described the MACD setup that can lead to easier markets. Our November 27th Copic curve analysis also aligns with the bullish outcomes in the MACD analysis from a probability perspective. And this week on short takes, we ran a rate of change analysis that also said after rare and extreme readings that we've recently seen on the S&P 500's chart, typically from an odds perspective, good things happen. Therefore, the key to success is continued and consistent implementation. Therefore, we'll head into next week with a flexible, unbiased, and open mind. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.